Today we're talking about IUL versus whole life. This is the insurance face-off you don't want to miss. We're going to go through the pros and cons of each of these policies, and different than you might expect, we're not going to recommend one over the other, but what we are going to show you is how each of them could fit into your financial world. Whole life insurance provides coverage for the life of the insured. In addition to paying a death benefit, whole life insurance also contains a savings component in which cash value may accumulate. Death benefit good for your entire life, popular for entrepreneurs utilizing certain financial strategies. The way we think about whole life insurance is that base foundational piece to your financial plan, right? So figuring out how to structure on top of this whole life insurance, other investments, other strategies, utilizing that cash value for the living benefits of whole life, it becomes so strong in the financial plan because there's not a lot of volatility or movement in that money. There's continuing compounding interest, which can't happen in other plans. Index universal life insurance is a type of permanent life insurance, meaning it has cash value component along with the death benefit. The money in a policyholder's cash value account can earn interest by tracking a stock market index selected by the insurer. Some of the benefits here: long-term death benefit, popular for upside potential, and income at retirement. So what are we looking at here? Well, whole life insurance, that cash value grows as a function of dividends and interest that is paid on the policy, that interest being contractual, the dividend not guaranteed. In an IUL, the growth of the cash value is based on the tracking of an index. So the safety component is that your money is not in the actual index. It's in the general account of the insurance company, and each year as that market goes up, or if it goes up, you're going to get a credited interest rate based on how that market index performed. So let me give you a quick example. You might have the S&P 500 that you're tracking, and that S&P 500 might go up, say, 12% in the year. Well, the index crediting in your policy may be 10%. So in that year, because the S&P earned 12%, what you're going to see is a 10% interest rate credit. The upside to this is that if there is a down market, meaning the S&P 500 for that year did negative 20%, what you're going to get is a zero interest rate credit. You're not going to lose any money because there's that floor, but you're not going to gain anything either. So these are the things to think about when you start digging into the IUL. So what you're going to see here is a chart of some of the differences between whole life insurance and IULs. First thing we're going to touch on is premiums, right? Whole life insurance is going to have a minimum, or well, according to this chart, it doesn't have a minimum required premium, but it does, right? There is minimum required premiums in both whole life and IUL. The IUL has a flexible premium structure, but a properly structured whole life insurance can also have, especially if you're overfunding, can also have that same flexibility that you can get inside of an IUL. When you look at this chart again, you're going to see guarantees, right? Whole life insurance has guaranteed fixed costs, where a IUL does not. And these are the things that you really need to start to take notice of. If you look at IUL illustrations based on the guarantees, there's not a guarantee of a death benefit long term. You may have to add a certain type of rider to guarantee that it doesn't lapse, because the cost of insurance goes up every single year, and the fees that are inside of that policy can also change based on the insurance company. So it's written into the contract that they can change the fees. It's not guaranteed that they will change them, but if the insurance company is having a bad year, you can almost be certain that those fees are going to increase. So looking at the whole life insurance, it is going to have that smoother growth glide path, right? It's a more steady climb and more steady increase in the whole life insurance, where the IUL does add for greater upside potential. So if you get in and you experience some really good markets, you can have some really nice growth inside of that IUL, assuming the cap rates or the participation rates in the index you're having don't change that much, right? So if those cap rates stay high, or those participation rates stay high, you can get really nice growth inside of the IUL. With whole life insurance, the other thing is, even though it's slow and steady, you do have that guaranteed annual growth, right? So it's in the contract that it's guaranteed to have cash value growth. So you will see that each and every year, plus dividends that come in. You want to be looking at solid companies that have a long track record of paying dividends. On the flip side of this, the IUL, what you're going to have is not guaranteed growth because it's based on market performance. So looking at that stock market, yes, there's up years, and yes, on average it grows 10-12%, but what happens and what you need to realize is what you're actually getting in that year, right? So each and every year you'll get interest rate credit based on however the market performs, and it should step up each and every year, but it's also giving you the floor. So when those bad years come in, you're guaranteed not to lose any money. As far as chronic illness riders, both policies have those. It is company dependent, and there are some different nuances to each of those based on whole life, based on IUL, and based on the companies that are issuing them. So, you know, if that piece is important, and you should be aware of what they are, just understand how they work. Are there any charges to them? What's the cost of those riders, if any? But it is important because, you know, what is a chronic illness, or how are those things triggered? Think about heart attack, stroke, cancer, right? These things are things that can happen to people at any age, and it gives you early access to the death benefit, right? So that you can use that money for whatever you need it for. So just be aware of the fine print when it comes to those riders. Both of the policies' cash values can act as a volatility buffer in retirement. And this is something we've talked about before on the channel, but the idea of being able to utilize cash value in retirement, not just as a tax-free stream of income, but really as a volatility buffer against your other market-based assets. In my opinion, whole life may work better in this situation because it is a non-correlated asset. And even though the IUL has that downside protection, the growth of it is still based on the market, right? So it is still a volatility buffer. I just think that in this case, as a volatility buffer, whole life may be a better part of that strategy. When you think about tax exempt, one of the things that I just heard the other day, you know, scrolling through Instagram, I see somebody being asked a question, and they were talking about having a lot of money in their 401k. And the person said, "I'm sorry." And the person off camera was a little shocked by the answer of, you know, what do you mean you're sorry? I got a lot of money and I'm going to be able to distribute it and not have any penalty. But they mistook penalty for taxes, right? And so here they are saving money into an IRA or 401k, thinking that after 59 and a half, when they start distributing money, that they're never going to have to pay taxes on it. They're thinking they put in pre-tax dollars and they're going to get out pre-tax dollars again and never pay tax on that money. And that's not the way it is. So be careful when you're looking at these things, that you really understand the strategy, not just of whole life insurance or IULs, but any financial product that you're in. Just the last couple points here, folks. As far as the death benefit goes, with whole life insurance and a good whole life insurance, that death benefit is going to grow over time. You can also spend a lot more down in retirement, and that's another conversation because of that death benefit. With IULs, there is a rising cost to that death benefit, although that death benefit does rise, and you'll see it on the illustrations. Important to manage that as you get older, especially when spending down. And the last difference is, with good whole life insurance companies, they're mutual companies, which means you, the policyholder, are an owner in that company, and that gives you the share in that dividend, right? Whereas when you own a policy and IUL, most of those companies are not mutual companies, and with IULs, you will not be receiving dividends. You only get growth and crediting through interest rates that happen based on market participation and that market index tracking. So just to sum up, with IULs, some of the pros: higher rates of return. You may be able to skip premium payments. There's a little more flexibility. The cash value grows quicker, assuming markets are working. Lower expenses, I don't know if that's true because there's rising costs inside those policies each and every year. And you do reduce the risk of outliving your money, especially with certain IULs. You get some guarantees on money coming out. With whole life insurance, the pros are it's a lot easier to understand. Far few moving pieces, stable premiums, not only set it and forget it mentality, but also the ability to have more guarantees inside of that contract. On the con side of both products, IUL cons, you really need to work with an experienced agent when it comes to the IULs, and they need to be tailored to what you're trying to accomplish. Don't just think that there's one type of design to those policies. Look at multiple designs. And with whole life insurance, the cash value accumulation can be slower, especially when it's compared to the illustration of an IUL. But just know the IUL, in order to reach those numbers, really has to perform each and every year. That whole life insurance, the performance is based on the company's dividend being paid. And more guarantees means that more fees. I think that's another thing where if you're working with the right agent, looking at these policies and designing them in the right way, especially if they're overfunded, you'll see that there's far fewer fees, so to speak, inside the whole life insurance. So the question here is, why do we prefer whole life insurance? You know, the question you should be asking, is an IUL a bank on yourself strategy? A lot of what we're working on is that bank on yourself type client, people that want to utilize that cash value, be able to leverage it out. Well, there's a lot of nuance when borrowing from an IUL policy. Borrowing from an IUL policy does not guarantee growth any year that the stock market does not perform. Whole life insurance does appreciate with time. IUL is not as clean and easy to understand as whole life, and often it's sold in a way to tell you that there is no downside. It's not that IULs don't work, it just needs to be the right strategy for the right person. So again, what does this mean? It means really understanding what you're getting into when you're looking at those products. Ask to see whole life versus IUL. Compare the differences on those illustrations. Look at what that is and understand, and then you'll be able to make the informed decision because you have the facts there and you can see everything that you're looking at. Thank you so much for staying through to the end here, right? We've gone over a lot of the differences here with IULs, whole life insurance. Please like this video if you enjoyed it. Share it with a friend or people that you know looking to get into either an IUL or a whole life policy, and subscribe to hear more content just like this. The last thing, if you go into that description box and you want to speak with a member of our team, click in that description box, open it up. There's going to be a link there. Click the link and one of our strategists will help walk you through the differences of the IUL and the whole life after they've gotten to understand who you are and what you're looking to accomplish. This will be a much faster and easier way, saving you a lot because you're not going to make the mistakes of getting into the wrong policy. And if you have a policy, we'd be happy to review that for you. Again, click in that description box below, fill out the information, and one of the representatives here will reach out to you.